Good evening. Welcome to the Loan Officer Training with the Mortgage Calculator. Today, we're going to talk about how to structure a down payment assistance loan. Definitely a requested training, so glad we're going over it here. We've had some requests for that. Down payment assistance programs are a very popular idea. Maybe Jose can touch on the fact that they're not the magic bullet, though, that some people think that they are. But definitely a good topic to go over here. Go ahead and drop a comment there in the chat as you're tuning in. You can also drop any questions that you have in the chat as we go through the training here today, and we would be happy to answer them. All right, it looks like we're live on all the different platforms, so we can go ahead and get it started again. Keep dropping comments in the chat. Put any questions you have in the chat as well. But we'll take the chat off the screen for now. So welcome, everyone. My name is Kyle Hershey. I am the COO of the Mortgage Calculator, and I'm joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender, and every Tuesday and Wednesday at 7 p.m. Eastern, what we do on the show is a new loan officer training topic. Today's topic is going to be how to structure a down payment assistance loan. So Jose has a presentation to go through here. Jose, our sales manager with 28 years of experience as a loan officer and a realtor, has dealt with many down payment assistance programs from all different angles. So I will turn it over to him, and let's talk about how to structure a down payment assistance loan.
Good evening, everybody. Thank you for joining us for tonight's training. As Kyle was mentioning, down payment is not, should I say, down payment assistance programs aren't necessarily everything they're cracked up to be. A lot of times it's more of an aphrodisiac to get the conversation started. However, there are some good programs and then some that, again, are may not be as cost effective. The one thing you do have to look at when examining down payment assistance programs, or at least the national type, not the local type that are agency related, but the national type would be what is the cost of that loan without down payment assistance? What is the cost of the loan with down payment assistance? And without down payment assistance, which is going to result in better pricing, would you be able to obtain a lender credit for the borrower by the borrower just selecting a higher rate, and in some cases being able to attain as much as 2% lender credit at an interest rate that is still going to be lower than the down payment assistance programs at 3.5%. Now, one of the things to note about the down payment assistance programs is that we have the forgivable and the repayable type. Most people, when they think of down payment assistance programs, are thinking forgivable, right? So, some type of grant that you don't have to pay back. So let me go right into the presentation here so that I don't repeat the stuff that I already have in there. So tonight is how to structure down payment assistance loans. Now, why did we choose this topic for tonight? Well, there's a lot of movement in the agency market. And we're seeing a downward trend overall. Maybe not the last couple of days, right? We've had a little volatility. Some recent data came out, but the overall trend is still down, right? They are talking rate cuts at the Fed. These are just, remember that a lot of this data is trending 6 to 9 months behind. So, we're seeing results now that are probably the result of action taken 6 to 9 months ago. That's why they're talking about around June to be ready. So, due to that, you don't want to react when everybody's ready. You want to set yourself up and be ready with the action plan. So, obviously, as the rates keep dropping, we're going to have more of the primary type buyer coming back into the market. And we want to have our shop tooled and in a position to be able to deal with all of this new business. So let me break down the down payment assistance and what I was mentioning. You heard me say national. Well, There's two types of options. We have here the type that is more locally based, usually funded by a city, county, or state government. This option requires the MLO and the company to be approved by that program to offer that program. So it's a localized option, right? Only going to be possible really to localized companies only looking to do a certain type of business, because you have to agree to compensation plans being extremely low and treat that all the way across all of your MLOs. So that's why it becomes difficult to do these localized down payment assistance programs when you're a national company. These localized programs are also usually going to be income based. And as I was mentioning about comp plans, they restrict the compensation possible by the MLO. So you have to be on that compensation plan all across the board at the company. Now, the other type of down payment assistance, also this state or local government type program, you have to apply for it, and only when funding is available is that program then a viable option. You could get yourself all approved for the program and then have to wait for the funding. These are usually the programs that you're going to hear that have larger amounts of down payment assistance, right? The ones that you hear of, even sometimes like a big second mortgage from the municipality of like 30 or 35% of the amount that doesn't have to be paid for. So those are really, what people think of when they think of down payment assistance. But what we're looking at here is more the national option, not an income based option, right? So you don't have to worry about income restrictions, not even a first time home buyer based option, but a primary home based option, of course. Um, for the national option, you don't have to be approved by any municipality. You just have to be approved by the conduit who you're submitting the loan to, right? And then there's a number of different ways it can be done. You have repayable option and forgivable option, right? The forgivable option had lower credit score requirement, a little bit more expensive on the pricing, higher rates, right, than the repayable options. And I'll get into why you would do one over the other as we're getting into the specific option. Now, most of the DPA options out there have different ways you can use them, right? Some are only for FHA, some are FHA USDA, some you can use for conventional as well. The options that we're going to be going over tonight, the forgivable option is available for USDA and FHA loans only. The repayable option is for FHA loans only. One of the things to note is that a lot of these down payment assistance options you see out there may require borrower paid pricing, which is going to affect the borrower's cash to close, right? So if the comp is 2.75, borrower has to pay 2.75 as well as the other fees. So now down payment assistance may actually be taking you backwards, because you're going to get 3.5% and the borrower has to pay now 2.75%, albeit a lower rate, but still higher costs. And the whole idea of the down payment assistance is lower out of pocket costs for the borrower, not so much the overall interest rate, but just they have very limited resources to get into the home. So that's the objective here. So let's go over the forgivable option. Offers the borrower 3.5% of the sales price to be used towards the cash to close requirement. Again, make sure to look for lender paid pricing option, because the best price option that I found still requires a borrower to bring 0.704 points to pay in loan discount, right, to get that rate. But 3.5%, and it's forgivable, which means after the customer has made 60 payments with no 90 plus day late payments in their record, the second lien is forgiven. Now, no interest ever accrues, no payments are ever due, so they may not forgive it if you're just a slacker on the payments, but it's not like they're hitting you with accrued interest because there is no interest on that loan due ever. Minimum 620 credit score for the forgivable option, and the DTI max on that is whatever AUS says. Now, the repayable option has a lower interest rate than the forgivable option. So one reason why you may pick the repayable option is strictly because of that. You want a good rate on the first. You don't think you're going to be refinancing in the next 5 or 6 years, and you maybe don't qualify with the higher rate on the first for the forgivable option, and so you'll choose the repayable option. Really, is the only reason I would see to choose one over the other, because forgivable is basically free money. The second lien that they put for the repayable option is at a 9.99% fixed rate, 30-year amortization, but very important to note, a balloon payment due in 10 years. So at the end of 10 years, the full amount currently owed is due. So it would be a good idea to refinance before that moment comes up, unless they happen to have the money and they can just pay it off out of pocket. The repayable option that we're going over tonight can only be combined with FHA loans. The forgivable option can be combined with, like I mentioned earlier, USDA or FHA. It's 3.5% of the purchase price or appraised value, whichever is lower is the amount of the assistance. And this can be used to for up to 100% of the borrower's cash to close requirement. Depending what how you structure the deal, they don't have to bring any money to the table. Minimum 660 credit score for this one, like I mentioned. DTI max is per AUS. Now, in doing my comparison between the forgivable and the repayable, I found that the repayable has best price option is 0.367 points less at the same cost, or should I say the same rate. So you can see the difference in the pricing. Now, another option that we have is closing cost assistance. It's a repayable closing cost assistance. So this one is only for FHA loans as well, the same 9.99% fixed rate, 30-year amortization with a balloon due in 10 years. There's a 1.125 point difference in cost higher from the 3% to the 5% program. And actually, you can go up to 6%, but they didn't have the 6% pricing in the rate sheet. They only had 3.5. So that's of the purchase price. So you have a 3%, 4%, 5%, or 6% of the purchase price closing cost assistance. Only, I doubt you're ever going to need 6%. That's a pretty high amount if it's a big dollar deal. But if it's only $100,000 deal, then 6% is only $6,000, right? So sometimes you may need the 6% for the borrowers that want to, do the deal with no money. Maybe now I take a step back, not no money, because this program does require 3.5% of the borrower's own funds, right? So 3.5% of the borrower's own funds here. No cash back. Again, max DTI per AUS 660, minimum credit score, no income nor first time home buyer restrictions, and the rate is still lower than the forgivable option. Now, why would you pick this option? Well, again, maybe you want 3, maybe you want 4, maybe you want 5, or maybe you want 6%. It is a lower rate than the other options as well. But it does require the borrower to bring in 3.5% of their own funds. So, again, a little less risk than the other options that allow the borrower to close with none of their own funds if you can structure the deal accordingly. So, one thing very important to note is make sure that you set the file up correctly, right, in your loan operating system, right, in your LOS. These are two separate sections that I put here, two separate snippets. The first one is from the Fannie Mae additional data form, right? So you could just go to Encompass, if that's the LOS you use, click, show all forms in alphabetical order and look for the Fannie Mae additional data form. Click on it and make sure that you put the source of the down payment as FHA gift source government assistance, right? If it's FHA loan, obviously, that you're doing it with, unless you're doing it with a USDA loan. Uh, but FHA gives source government assistance. And then the other snippet down here is from section 4D of the ERLA, where you are including the gift. You have to first click show all gifts or grants. That opens up the section where then you click the plus sign to add a new entry, and the new entry is going to be this entry with the for the borrower, the gift of cash from a federal agency, deposited no, the amount of the gift. And then doing it in these two manners, in these two ways, will ensure you that AUS will pick up the gift being from a governmental agency and will know that it's down payment assistance so that you don't have any problems with your AUS findings. That's how you get it to properly code for these DPA type programs. So let me give you now some examples on what pricing we have for the different options out there. Now, these are all based on a $450,000 purchase price. So, for the first example, the forgivable option, I use a 660 credit score. Below a 660 credit score, there are adjustments to the cost. So, I use the rate with no adjustment, and I use the 15-day pricing. And you're looking at 8.75%. Is still going to cost the borrower 0.704 points. That's the highest rate option, the highest rate that we could attain with the lowest cost option. Remember, this is a forgivable option. Payment 34.76. This will give you an idea of why they're going to pick one over the other, right? So now in our forgivable DPA for USDA, forgivable is the only option here that we can combine with USDA as well as FHA. So here, 660 credit score. It's a little bit more expensive than the FHA at the same 8.75% rate. We're looking at having to pay 1 point, right? Whereas FHA was 0.7 points. So it's about 0.3 more expensive than FHA. Again, 660 credit score is a score with no adjustments. And then my next one now is repayable. Now here you can see the difference, right? The payment here is $195 lower than the payment on the forgivable option. So even with our $141 per month payment to the second, we're still paying $54 less overall per month on the repayable option. But again, we're making payments for 10 years versus the other one, don't make any payments, and after 5 years, it's forgiven. But you still keep making that higher payment until you refinance out of that first loan. So that's really the situation we're looking at here. So, but you see, obviously, 8.125, much lower rate at approximately the same cost for a repayable DPA. And then in our last example here, we're looking at repayable FHA closing cost assistance. Wow, that's an alphabet soup there, right? And in this case, I picked the 4% closing cost assistance example with a 680 credit score, right? It's again 680 is the credit score at which there are no adjustments. You can go down to a 660 on this program, but I believe there's like a half a point in cost loan level price adjustment if you drop below a 680 down to the minimum of a 660. I try to keep it apples to apples. The down payment assistance is 3.5%. So rather than pick the 4% option, I picked the 3%. Rather than pick the 3% option, I picked the 4% option. Just so you know, the difference in the cost between one and the other, the same rate is going to cost a half a point less at the 3% option. So in essence, you get net half a point more benefit from the 4% option than the 3% option. So because it costs you a half a point more expensive to get, so in essence, net you're getting a half a percent more, but you're getting 1% more loan. So here we are 7.75% with a cost of 1.013. And again, this one is offered in a 3%, 4%, 5%, 6%. Obviously, the higher the percent, the more expensive the loan, to the point that it becomes almost fully borrower paid. So I hope you appreciate and you got something out of the ins and outs of down payment assistance. There are cases when down payment assistance will be the only way that your borrower can reach the finish line, but you do always, if your borrower is that close and they only need a few $1,000s, uh, a lot of times you're going to be better off not going down payment assistance, trying to bump up the rate a little bit to give them some lender credit. Because in essence, that's what they're doing with these down payment assistance programs. That's why they all have higher rates. It's like a different rate sheet that they're giving you. And then it's not always as favorable, because if you go sometimes to a regular FHA rate sheet, you can get 2%, 2% lender credit at less than half what it's going to cost you to get, let's say, 3.5% lender credit. But I'm saying less than half in terms of the difference in the rate spread between what you're getting at par versus what you're getting in rate with a 2% lender credit versus the 3.5% down payment assistance, which you could almost call it another type of lender credit.
Okay. All right. I don't see any questions, so we can go ahead and wrap it up. Remember, we do this on Tuesdays and Wednesdays at 7 p.m. Eastern Time, where we go through a new loan officer training. So we appreciate the training there, Jose. Thank you, everyone. We'll see you next week, Tuesday, 7 p.m. Eastern, for the next episode of the loan officer training with the mortgage calculator. Have a good night, everyone.
Thanks, everybody.
Thank you, everybody. Have a great night.